As long as they cut rates as anticipated, I believe through the end of the year, we should see gold hold above 4,200. It's $20 above that now. 39.80 wouldn't be good, but I believe 4,200, because it is what we call a century mark, tends to have a lot more emphasis or importance to it, even though it's 4,200 versus 4,203 or 39.97 are very much the same price per troy ounce. It isn't perceived that way by traders as well as speculators alike.
In a recent market breakdown, veteran precious metals analyst Gary Wagner shared his outlook on gold as the Federal Reserve prepares for expected rate cuts. According to Wagner, as long as the Fed follows through with easing monetary policy, gold should maintain a strong position through the end of the year. He emphasizes that the key level to watch is $4,200 per ounce, a price he describes as a century mark, a psychological threshold that often carries extra weight among traders and speculators. Gold is currently trading just above that level, around $4,220, reinforcing Wagner's view that bullish momentum remains intact. While a drop to $3,980 would signal weakness, he believes the market is unlikely to revisit those lows if rate cuts unfold as anticipated. Even though small price variations, such as $4,203 versus $3,997, represent minimal difference in real value, market perception plays a crucial role. Traders tend to react strongly to round numbers, and gold consistently holding above $4,200 would signal confidence, stability, and ongoing demand. As global economic uncertainty continues, this century mark could become the defining indicator for gold's next major move. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
Well, headed into the new year, we've got one more Fed meeting. That, of course, is going to conclude on Wednesday. This being Monday when we're recording, it is highly anticipated that the Fed will implement a 0.25% rate cut. If they do that, I believe that that is pretty much factored into pricing. I would look for gold to hold steady. If by a slim chance, because according to the FedWatch tool, I believe it's 84 to 87% probability of that rate cut. It will be statements made as to future rate cuts that will really move the market. And right now, I don't think the Fed wants to rock the boat. I think that what they want to do is inflation has cooled a little bit, but it's still well above their 2% target. And so they want to bring that into alignment. But at the same time, they're cutting rates, because what is the one tool that the Fed really has, raising or lowering of interest rates? When you have sustained high inflationary pressures and they are above their target, you typically leave rates alone or raise them. That would be how they would use that tool. They're doing the opposite to stimulate the economy, and that's understandable because the labor market has been contracting. So they're dealing with both issues to call for different actions in terms of raising, lowering, or keeping rates the same. And they have chosen the more aggressive action of cutting rates, and that's their decision. We'll see how that reflects within the market as long as they do that. If they raised it by a half rather than a quarter basis point, that would be a substantial differential that the market hadn't accounted for. And if they don't cut rates, that would be not as substantial. But considering the highs that came in, where we had intraday highs very close to 4,400, we had a correction down to 3,900, very acceptable correction. And really only that's one of the two major corrections that we've had this year, ever since gold went parabolic. And it went parabolic middle of August at around 3,300, went to the all-time record, an acceptable correction, which I felt was absolutely necessary, because the market, especially when it's parabolic, when you've got that kind of a rise, you tend to have a very steep fall. We did get a steep fall in terms of time distance, because gold went from about 4,400 down to about 3,900. But sitting above 4,200 is, again, phenomenal. We've had an exceptional year. The one big correction that we had came right after a parabolic move, to be expected. We needed to see prices kind of cool a little bit. And I think as we go into the end of the year, beginning of next, now we have volume starting to decrease as we get into the heat of the holiday season. And then, of course, New Year's. We do see volume going down. And what that can cause is jumps in the market due to lack of liquidity because of low volume. That, of course, will correct itself as traders return on the 1st of next year, 2026. So there is always the opportunity for traders to come in and hit the market hard. I don't think that's the case because gold over the centuries has had an intrinsic value. That asset class, precious metals, have always maintained in the eyes of investors as an asset that has intrinsic value. Real estate is another one, but liquidity is different. But in terms of the precious metals, I would look for them to be rather, I believe that they'll continue to climb, although I expect a couple of hiccups along the way, and those hiccups will probably be due to unknown circumstances that come into the market. A big contraction in the labor market, big changes in political things. Gold always reacts to negative things in the news, hardships in the news, and peace is not one of them. I would rather see gold go down and peace be prevalent, but I don't make the rules, nor do I have any factors in which I influence it. So we'll have to see what happens, but I am bullish for next year on gold, extremely bullish on silver, and maybe we'll have some time to touch on that in a little bit. If it continues to move up, we have a hard ceiling at 4,400. So if it moves off of the 42s to 43, I don't really see any technical resistance of it moving a couple $100 higher. However, even if it flirts with 4,400, that's the all-time absolute top, and that's where maximum technical resistance is. And it will take a very, very strong fundamental backdrop to break through that one level. Other than that, I see, if it continues to move higher, I see it moving up to 44 and then finding resistance. If it moves lower, there is really, really strong support at about 3,900 to 4,000 per ounce. So we've got that $400 range right now. We're sit right in the middle.
In this in-depth market analysis, renowned precious metal strategist Gary Wagner breaks down what investors should expect as the Federal Reserve approaches its final meeting of the year. With markets widely anticipating a 0.25% rate cut, Wagner believes the move is largely priced in, meaning gold is likely to hold steady unless the Fed surprises with stronger or weaker action. According to FedWatch data, the probability of a cut sits near 85%, but Wagner warns that future guidance, not the cut itself, will be the real market driver. Despite inflation cooling slightly, it remains well above the Fed's 2% target, forcing policymakers to balance slowing economic activity with lingering price pressures. Cutting rates into elevated inflation is unusual, but Wagner notes the labor market has weakened enough to push the Fed toward a growth-supportive stance. Any deviation, such as a half-point cut or no cut at all, would create volatility the market is not prepared for. Gold recently hit intraday highs near $4,400 before correcting to around $3,900. A pullback Wagner considers healthy after a parabolic run from $3,300. With gold now stabilizing above $4,200, he sees strong support between $3,900 and $4,000, and heavy resistance only at the $4,400 all-time high. Low holiday trading volume may trigger temporary spikes, but he remains bullish heading into 2026, especially on silver. As always, geopolitical shocks, labor contractions, or unexpected turmoil could accelerate movement. But the long-term trend, in Wagner's view, remains firmly upward. Let's get into the interview.
Well, silver's in a precarious place because of the speed at which it moved up, considering that back as early as the last week of November, it was at $48. Silver's really been playing catch up. We've had multiple new all-time record highs in gold, and silver stayed flat for so long. And then it took a lot of people by surprise because considering the move from $49 to almost $60, that's a huge move. A tremendous move. And considering that silver was down, let me look at my chart. That's back in April, around $29. It has doubled in price. And so next year, if it continues higher, it's going to be interesting because whereas gold is off of the record high and we know where real resistance is, silver is really 5850 is the most active March contract, and that's really, really close to the all-time record intraday highs that we're flirting with 60. 60 is a big number. If it makes it through 60, now, like we've seen in gold, we go into uncharted territory. And as a market technician that looks at charts and previous actions and price points, it becomes very difficult to predict what a new all-time record high could be in silver because it's never been there. And as a market technician, I look at fundamentals. If the fundamentals move it higher, they will. But the technicals are going to be less important once we, or if we break that $60 mark and go to new territory. There are really no technicals to look at. You can look at some oscillators, whether it's overbought or oversold. Typically, as it moves up and goes past records, it's going to be overbought. But if you look at, for example, stocks that tend to cycle for years and move in to higher levels, it remains overbought for quarters and years as it moves to higher ground. Whereas something like silver or gold, we see a much greater fluctuation in terms of price. So 60 is the mark we want to see if it's broken. If it does, as a market technician, I have no information to pass on as to what it did last time. It was at $61 because it's never been there.
Silver is entering one of the most unstable and potentially explosive phases the market has seen in decades. After spending years lagging behind gold, the metal has suddenly ripped higher with astonishing speed, doubling in price since the spring and surging from the mid-40s to the doorstep of $60 in just weeks. This violent acceleration has put silver in a position traders rarely see. A market pressing against its all-time highs with no historical roadmap beyond the next major level. Analysts warn that the $60 barrier is more than just a psychological milestone. It is the gateway to uncharted price territory. If silver pushes decisively above that threshold, traditional technical analysis becomes almost useless. With no prior data points beyond this region, momentum, fundamentals, and investor sentiment take over. And in a market where long-term supply constraints collide with relentless demand, the outcome could be dramatic. Once a market breaks into territory, it can remain overbought for months or even years while establishing its new normal. That's why this moment matters. Silver has never been here before, and a breakout could redefine the ceiling entirely. If you're watching this historic setup unfold, buckle in. The next move could rewrite precious metal history. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.